UK is never a trap. Part 2. The mortgage system is not a trap. Let us talk seriously about mortgage. People say the UK mortgage system is a trap, but I want to ask you something honestly. Is building equity in a regulated system a trap, or owning nothing in an unstable system the real trap? That question is waiting for you to answer. Let us slow down and break this conversation down in a calmly manner, logically, and with facts. Because emotions shout, but system speaks quietly. Let's talk about structured ownership. In the UK, every mortgage payment reduces your debt. Every single payment moves you closer to ownership. You are not just paying to stay somewhere. You are paying to own. Over 20 to 30 years, the loan reduces gradually. And at the end, the property becomes fully yours. Legally documented, protected by law, recognized by courts. Not partially owned, not spiritually owned, but legally owned. Compare that with renting for 20 or 30 years. At the end of that period, you may have paid a similar amount, but you owe nothing. Now, let us talk about security. In a system where land administration is inconsistent, ownership can sometimes be challenged by disputes, political decision, redevelopment claims, or regulatory shifts. There have been instances in major cities where demolitions happened under redevelopment or infrastructural expansion claims, sometimes with controversy or prolonged legal disputes. The key issue is predictability. In the UK, if the government needs land for structures, there is compulsory purchase law, there is due process, there is evaluation, there is compensation, there is court protection. It cannot happen casually. Ownership backed by enforceable law is not a trap. It is structure. Let's talk about access and regulation. UK mortgages are regulated by the Financial Conduct Authority. That means interest rates must be transparent. Terms must be documented clearly. Affordability must be assessed. Repossessions requires legal procedures. You cannot lose your house overnight without due process. Yes, the bank can repossess if payments completely fails, but even that follows a structured legal pathway. In contrast, in many developing systems, mortgage interest rates can exceed 20% annually. Loan tenures are shorter. Access is limited to a small percentage of the population. As a result, most people rely on personal savings and incremental building over many years. That approach is admirable. It shows resilience, but it is not the same as having a structured national mortgage framework with consumer protection. Strict is not the same as oppression. Strict often means stable. The system screens you before approval. Before you are approved for a UK mortgage, lenders check. And what are the things they check? Stable employment history, proof of income, credit score, deposit service, affordability under stress testing, often life insurance, sometimes income protection insurance. They test your ability to survive interest rate rise. While all this check, because the system is designed to reduce failure. Mortgage is not for impressing people. It is not for showing off. It is for disciplined long-term planning. If someone rushes in without preparation and later struggles, is that the UK trapping them? Or is it poor financial planning? In the UK, if you lose your job, there are structured welfare systems, unemployment support, and healthcare access. Is it perfect? No, but it is predictable. Predictability allows planning. Planning builds stability, and stability gives you hope. Let's talk about property value and long-term growth. Historically, UK property values trends upward over long period. Although there are cycles and downtimes, it is not magic growth, it is long-term compounding. If you hold property over time, you typically benefit from both capital appreciation and equity accumulation. Meanwhile, in less stable system, property value is heavily influenced by political inconsistency, infrastructural delivery, land disputes, regulatory changes, and security conditions. A property can be expensive today and uncertain tomorrow, depending on policy shifts or local instability. That is not the same as security. Value is not just what something costs. Value is how well that ownership is protected. Sometimes, a modest house in a small UK town provides more predictable long-term security than a luxury property in a volatile. That is not emotional, that is structural analysis. Let's talk about the long-term stability. The UK mortgage system is designed for generational planning. You build credit history, equity, financial reputation, inheritance potential that creates continuity. In systems where infrastructural projects displaces communities or compensation process becomes prolonged legal battle, long-term planning becomes uncertain. Uncertainty is a bigger trap than structure. A system where you cannot predict tomorrow is more dangerous than a system that binds you with clear rules. Rules may feel uncomfortable, but rules create protection. Let's talk about financial independency. When you pay a mortgage in the UK, you are building equity. Equity means ownership. Ownership means asset. Asset means leverage. You can refinance, you can sell, you can pass it to your generation or to your children. That is financial progression. In environments where documentation enforcement is inconsistent, resale security and dispute resolution may feel fragile. Ownership without strong enforcement can feel uncertain. Again, this is not about insulting any country, like I received some backlash in my last post. It is about comparing systems objectively. My personal conclusion, I could rather invest in a UK mortgage that is slow, steady, regulated, and protected than own something outrightly in a system where enforcement is unpredictable. Because in the UK, ownership is backed by institution. Here, home ownership is not reserved only for the ultra-wealthy. It is available to anyone who qualifies and plan properly. That is access, not trap. Instead of saying the UK is a trap, maybe we should examine why structures feels uncomfortable to us. The UK does not promise overnight riches. It promises fairness within rules. It exposes impatience. It exposes shortcut mentality. It exposes poor planning. I know Nigerian teaches hustle. The UK teaches structure. If you reject structure, you will feel trapped. If you embrace structure, you will build quietly and steadily. That is not a trap. That is a delayed gratification backed by law. And in my part 3, we will discuss something even more controversial: car finance. Why do many people believe something designed to increase mobility and access now feels like a financial trap? It is the design of the system, or is it how people use it? That conversation is next. If this feels true or balanced to you, kindly give it a like. If you don't feel the same, drop your thoughts in the comments. I genuinely want to hear your perspective. And please share this with someone who might need a mindset shift today. Thank you for listening, and God bless you.